All right, your first time at Milken. Why is this your first time at Milken?
You know, we just hadn't gotten together as a firm to come here, and we decided that we ought to be here. The entire finance investment ecosystem's here, our capital providers, company CEOs, a lot of other GPs who are our friends and competitors, and we're glad we're here. It's been a great event.
I mean, the AUM in this room went up dramatically when you walked in. But I am curious. I mean, are you welcome with open arms here, or do you hear like the Death Star music when you walk in?
No, private credit people.
We're important counterparties to them, but Mike has been a friend of the firm, Mike Milken, for a long time, and a lot of us know him. And we've always talked about coming, and you have to get it together. You got to organize yourselves. We're here with 20 people, some of the senior most people at our firm. And it's been great. Yeah, everybody's super receptive. A lot of our good friends and relationships.
Are you looking to do deals here?
No, it's just about making connections, seeing our important investors, seeing other guys in our industry, seeing maybe potential new sources of capital. So it's not really a deal specific.
I love talking to private equity, and I just want to make sure I get the numbers right. You've got 126 roughly portfolio companies that you guys are invested in, about 143 billion, we said, under assets under management. You see a lot through them. They give you some great visibility on what's going on globally. So what do you see through them?
Well, we're seeing the economy being still quite strong. The rate of growth is decelerating. We've got full employment in this economy. We've got good wage growth.
Rate of growth decelerating.
The rate of growth is decelerating. We're actually seeing inflation under control, largely across everything in our portfolio. I think the big sort of revenge travel and leisure spending is beginning to come down a little bit. But overall, the economy is strong, and we're not seeing evidence of the big inflation. To us, that's in the rearview mirror.
Is that something, though, specific to just your companies, or is that really economy-wide?
I really think that's more writ large across the economy. I think it's not quite as low as the Fed's looking for, but we're not seeing it as problematic in our portfolio in the way that we were 18, 24 months ago.
So the trajectory is favorable.
Yes.
Not just on inflation, because when you talk, as Carol said, about the idea of that growth rate coming down, is that going down to, I guess, a normal level?
You mean in inflation or economic growth?
Economic growth.
I mean, I don't quite know what a normal level is, but I would say the economy is slowing, for sure.
Yeah. And that's across all the industries in terms of the growth decelerating.
I mean, there's a couple of bright spots, of course, and we can talk about themes. There's a very significant investment that's going to be required in the power grid in this country over the next decade on the back of data center demand and electric vehicles. So, there's certain parts of the economy, narrow seams that are growing rapidly, but I'd say general consumer spending, industrial production, that's going to slow down a little bit.
Joe, what's the environment like to find deals? And private equity, then there's private credit out there. I am curious if there's a lot of capital chasing similar deals and what that does to pricing.
Yeah, honestly, it's hard to raise money. And GPs understand that the amount of capital available to them is going to be a little bit lower than it was 3-4 years ago at the top of the market when money was free and rates were low. So I would say there is more discipline in the market that we're seeing as we're looking to buy assets. We've invested from the summer of 22 until the summer of 23. We invested about $9 billion in great companies at much better pricing than we would have been looking at in 2021.
The discipline is a good thing.
The discipline is a good thing. I think this is a good time to be a buyer. Higher cost of capital. When it's cheap and debt's plentiful, it accrues to the sellers of assets. Yeah. Now, I think we're being able to price things a little more rationally.
But you probably had to be a little bit more creative as well.
Yeah,
and I'm curious if you can give us some specific examples. I mean, for example, I was taking a look at the deal for Rover, the dog walking service, Carol, which I actually use, just full disclosure here.
Hope everybody uses it.
But maybe you can just talk about kind of how that was structured and why.
Well, that was a public to private of a company that had great growth, but it kind of got lost in the shuffle. It was a SPAC, and SPACs were kind of not that loved. It wasn't well followed. It had a couple of major shareholders, and we were able to strike I think a fair price for a really good company that had been overlooked and unloved in the public markets.
We've been talking so much about the idea of the IPO pipeline, the avenue to public markets being, if not closed, certainly not as greased as they were in years past.
Yes.
But we've also seen a lot of take privates as well. So basically the traffic going the other way. Which one do you think is going to kind of dominate over the next 6 months to a year?
I think the IPO market's cyclical. I've been doing this for 30 years, and you see IPO markets open and close. A lot of people are saying the IPO markets are dead. I do not subscribe to that. I think IPO markets will come back for really good companies. It may be more discerning. It's going to be different kind of businesses. It's probably going to be the larger scale businesses in our portfolio that are going to be most attractive for IPOs. But I think it's going to come back. You just have to be priced attractively so public market investors can make a good return.
Joe, there's coming back, right? And then there's coming back to what it was. So when you say it's coming back, meaning that what, we're going to see a little bit more activity, or does it go back to some of the higher levels that we've seen where it seems like there were new issues almost every other week?
No, I think it'll find some kind of mid-cycle. If you look at 21 when everything could go public and it was just a rush, to the public markets.
Better or worse?
That was not sustainable. I think we'll go back to some sort of mid-cycle concept where you have to go back to probably 2017, 18, 19 and look at IPO levels then. But my point is, we own a lot of really high-quality companies, and public market investors are going to want to own those. And I think the IPO market will come. I can't tell you exactly when, but I think it will come back.
Do you feel the pressure, though, to start exiting investments? I'm just curious from your investors how much pressure you're feeling.
I mean, fortunately, we've been able to return since the end of 2021, so since the market began to turn down, almost $20 billion of capital back to our investors. We had many companies that were already public that have held up well, where we sold positions. We've sold companies to strategic buyers. We've sold companies to some of our competitors. So we've actually been able to return capital. We're not feeling a lot of undue pressure, and that's one of the beauties of private equity is we control the exit. We get to decide when to sell. And I think that's part of the reason we've been able to outperform public markets over a long period of time.
Joe, I want to ask you specifically about your business, meaning how you're managing people internally.
Yes.
You were involved with a program called Career Pathways. The idea was to find kind of a untapped talent pools, if you will. So whether that was minority groups or veterans, things like that. You know there's been a little bit of a public pushback to some of those initiatives here. How much of a commitment do you still have to that?
So, I've been on the board of Year Up, which is for about 10 years, which is an organization that helps people who haven't had access to career-sustaining jobs get the training and an internship that converts into a full-time employment. And I've seen that just fundamentally change worthy people's lives. And I wanted to bring that across our portfolio companies to look systematically at how we're recruiting talent. What's the educational requirements? Do you need a BA degree to do a particular job? Are you accessing talent pools that historically didn't have access? And we're fully committed to that. I think that is an unequivocal good for society, for our companies, and we'll continue to do that.